everybody. Welcome to Friday, another Talk Money with Tom show. Today, we're going to be trying to help you improve your retirement, at least financially, as much as we can. We do that by answering questions. We answer a lot of questions during our client strategy sessions. So some of those we bring onto the show. You can send those questions in anytime during the week. You can send them in now. We'll try to answer them live. You can do that two ways right now. The email address, asktom@talkmoneywithtom.com, or the chat window inside of the YouTube channel here. You can post something. We'll try to answer that live also. So, we focus on retirement planning and asset management and tax planning. Those are the big areas that I think are, areas that aren't, taught in school per se. And that's why we have this channel here to try to help people as far as that goes. We've been doing this for a long time for a lot of different people. Obviously, we have a channel here with a lot of resources on it. You can go on here. I think we're getting close to 2,000 videos on here now. You can subscribe to the channel and then push the little bell button. You get notified whenever we put new content on. And that's, just start your process of, even if you have an advisor, I think it's a good idea to have more knowledge about how to invest or how to reduce your taxes in retirement and those types of things. And then, of course, lastly, if you like, you can just meet with Ethan and I. We'll meet with you, a half hour, no cost. And we have a book appointment button up in the corner of our website. The link for the website's here on the channel. You just push that, and our calendars are live, and you can find a half hour time to meet with Ethan and I, and we can, discuss your situation on a more personal basis. So that's the, hope today is that everybody can kind of grab, one thing that they might be able to use as far as that goes. So I do like to start off the show each week with a summary of kind of what's happening in the markets overall for the last week. And pretty good time to talk about this. I mean, today is triple witching day, right? Mm-hmm. With the options expirations and those types of things. So the market was down a little bit as the show started here. But yesterday was a really big day, up 1.7%. And more importantly, it broke through to a new all-time high.
Yeah, it finally broke that resistance level.
Yeah, and you can see, this chart goes back, to 2018 timeframe, and you can see what's been going on and the nice run we've been on here. However, if I bring this in, a little bit closer, so just year to date, this is a daily data. And so you can see, had a nice run and then about a 5% drop there in April. And then a really good run out of that up until the 16th of July. That was our all-time high for quite a while. And then a pretty good size drop. That's an 8.5% drop in August, and an unbelievable recovery, right? And then another big drop the first week of September this month, and another recovery. Kind of amazing. And we're still, setting higher lows all the way through, even in this time frame. But what's important here is I put a couple of lines there to emphasize this. I really like what's happened this year at the moment in terms of this kind of consolidation that we've got, right? We just spent 8 weeks going sideways. Lots of ups and downs in there, but essentially going sideways. And what happens is it means that there's a lot of shares accumulated at the pricing that's in that range. And so if the market jumps above, which it has done, and starts to come back down, and actually you can see that in today's data, it's down near the top, it's kind of hitting that support level. It becomes support because somebody says, hey, I bought it at this and it went up. If it gets back there again, I would buy some more because I was successful last time. That's the theory behind support. I think it's important to go sideways for a while, just for the stance of we've had such a big run. I mean, as of yesterday, we were up over 20% for the year, which is a really good year. Last year, we were up over 20% also. So, we've got a lot of stretching going on here. So having it go sideways for a while, it allows the pricing to get less out of control, earnings to start to catch up to the pricing, and it provides this support level. So this is a really big deal. We'll see if we keep it. I wouldn't pay too much attention about what happens today. In my, time frame of watching the markets, it seems like most of the times a triple witching day, the market is down that day. There's a lot of, it's sort of a temporary thing. It happens once a month. So it's not something I would hang my hat on. I wouldn't worry about what's going to happen today per se. I think more interesting to see what's going to happen next week. The market dropped when they announced the 0.5 point rate cut that day on Wednesday. And this was a big deal because the betting in the futures market was more weighted towards a quarter point rate cut, and they ended up doing a half point rate cut. And so at first, in my opinion, I even said that the day before, everybody's expecting the market to go skyrocketing on a rate cut, and they're all on one side of the trade. And often when that happens, you end up going the other way. There's just nobody else, on the other side. And so it's pretty easy for them to make an impact. And that's sort of an ongoing theme, actually. When everybody is talking about something, it rarely happens that way. With the market. The market, generally will respond better to things that, or worse, to things that we're not talking about, right? And so, very important though, they started the rate cut regime off here. Again, we presented last week that the last 11 rate cuts within 12 months, 9 of those time frames were up versus down, and up an average of 14%, right? So it's 82% or something like that for the last rate cuts. And it really just comes down to, why are they doing a rate cut? Are we having a rate cut because we have softness that's coming into the economy at a pretty high rate, and now the Fed is really just behind, and so we're going to end up in a big recession? So because the 2 times out of those 11 when the market didn't make money was in 2000 and 2008 timeframe, those 2 big downturns. And so you'd had massive numbers of increase of rates by the Federal Reserve in those timeframes, and the economy really just fell apart in both timeframes. So that's going to be the thing that everybody's looking at here. Inflation probably going to be less talked about. The election's going to be a really big focus here in the short term, but I still think that the recession, fear of recession, and that's, if you look at like even the beginning of this month in September, we had a big drop. It was only a 4-day week, because of the holiday, and it dropped every day, mainly because we were getting numbers about the jobs market being softer, right? And, the Federal Reserve has a dual mandate, have full employment, which they consider roughly around 4% unemployment, which is interesting, or better, right? Yep. And then a 2% inflation rate, looking at core PCE as the measure. And so we're at 2.6% on PCE. We've kind of flatlined the last 3 months on that. But the labor market has gotten soft. The number of job openings has come down some. The number of first-time unemployment claims this week actually did quite well, which is kind of interesting. But it had been doing not as well. Matter of fact, this week is the best first-time unemployment claims that we've had since May. So, not that far back, but nonetheless, partly why we saw the market move so much yesterday was because that's the soft landing. That's the whole thing, where you end up with the economy that does okay in an environment where they had to raise rates pretty dramatically in order to fight inflation. Inflation comes back down. I mean, we're not through this yet. We've got, talk to me in 2026 or something when we can really see the impacts of all these things. But so far, we're kind of threading the needle. It's been amazing. Yeah. I mean, there hasn't been anything like this in my 37 years, that's for sure, where you had, a situation where they raised rates, from 0 to basically 5.25 very quickly, and we didn't have a recession. And you're going to have a recession in every other environment that I've ever been involved with. And Wall Street, at least last year especially, was really caught flat-footed. They were expecting recession last year to really kick in, because that's what happens. But what you have here is that pandemic and that pent-up demand and all the money that the government had pushed out, to try to support the economies of the world, not just our government, but all the governments. And that money's just kind of sloshing around. And then you had a lot of people, they want to get out and travel, want to go out and do all these things that they couldn't do for a little while. So it ended up being an offsetting kind of teeter-totter scenario where things kind of evened out, and we still have economic growth, even though, we've have this higher interest rate picture. So I think it's kind of fascinating how this has played out. I still think there's a lot of room to run for the market. Again, we are in this weird time frame before the election where, at least for the last 5 presidential elections, when we showed that on the chart, on the last show, it's been negative for that 60 days before, right? I wouldn't be surprised to see this thing struggle. However, we did break up into this new high, and so it's kind of interesting to see how that plays out. It hasn't broken up that much. Can it fall back in there? Sure. It's not a one-day thing. It's more of a longer thing. A couple weeks. If we can stay above, then we're probably going to keep going. But again, I wouldn't be concerned about this type of activity that's happening here. This is just a kind of the market's waiting to see what happens with the election. The market is, okay, there's nothing really wrong with the economy, the jobs, the earnings. Yes, things are slowing down some, but they were too hot in the first place, and that was what's causing some of the inflation. So, as long as it doesn't over slow down to the point where we end up with a recession, and that's what we watch for. I don't see that yet. I wouldn't be surprised to see a recession, but it's just the indicators are flashing red in the sense of, the traditional inverted yield curve, those types of things. Yeah. But man, those things inverted, what, a year and a half ago or more?
They're finally positive now.
Yeah, now they've, back into normal curve, the inflation rates, the interest rates on treasuries. And so, those things didn't pan out. The leading economic indicator, which has an incredible track record, went negative. And we have not had a recession. Now, maybe it's just early, like really early, like a record early for those indicators. Or maybe those indicators we look back till, 1970, we look back to World War II. What we are not looking back to, not really capable of looking back to, is the last time we had a pandemic.
Yeah, that was what,
1918. And so, things have changed too much anyway. There was no S&P 500, there was no NASDAQ, there was no Russell 2000, there was just the Dow, right? There was 90% actually, in that time frame, they had 90% margin, and that's what, part of led to the run-up of the
Roaring 20s.
Yeah, the Roaring 20s and eventually the Great Depression. So, the time frames are too different as far as that goes. So now you throw in artificial intelligence, you throw in some good earnings from companies, pretty solid earnings again, you end up with a market that's doing pretty well. So here's where we are now. We just had a trend change on the hourly, back to green yesterday. So again, we're just tracking the primary trend of each one of these hourly, daily, weekly, and monthly. And we had it go red in July at that peak, had it go red in September at that peak, right? And it's back to green as of yesterday. So that's, every trend piece, daily, weekly, monthly, and hourly, are all green now. And then we look at market breadth. This is a much slower moving piece. We're just trying to see. This hasn't actually changed since June 3rd. And just looking at these different broad market, ETFs and some sector ETFs that are representative of the markets, the economy, maybe more like semiconductors and utilities and transportation. The only one that's red is transportation, and that's actually pretty close to breaking out to green. We'll see. Might not do it, but it's getting there. So anyway, that's overall the market is fairly healthy as far as that goes. There's no issues. Yeah, like I say, we've gone sideways for a while. I think that's a good thing here in the short term. And then we talked about this last time, where we're seeing this rotation in our ETF list of things that are moving quite well and where the money's coming. And so we had gone from, in our targets, we have a majority of our money outside of targets. And here's something I recommend to think about this. We are seeing a lot of rotation right now. And the best way to fight that rotation is to make sure that you have a lot of your money in things that cover almost everything, like the S&P 500 or the Vanguard Total Stock Market Index, which covers almost every stock. That way, as it rotates around, you're not having to chase that and underperforming. We use this little slice of what we call our targets to try to outperform the market with this piece. It works, overall, but periods of time it doesn't work, But what was interesting was real estate, healthcare, financials, consumer staples, and minimum volatility. The market was moving into a, safer area.
Yeah, low volatility.
Yeah, the money was coming into that area. And as of today, actually, we sold healthcare, we sold staples, two defensive categories, and bought Focus Value, which is a iShares ETF, and we bought cloud computing. And so we've had that cloud computing in the portfolio a few times. So you can see there's a little bit of a shift going on. And again, very difficult to keep up with that shift as far as we're concerned. I just find it kind of fascinating to see what is moving more than anything. And make sure you have, in this environment, there has not been a solid run in any particular category for a while. We had a really solid run in the big tech for quite a while,
Yeah.
right? For over a year. You could launch into that and just continue to outperform the market. And now we're in this choppy seas where things are moving and rotating. So it reminds me a little bit of 2021. The rotations don't last that long. It's hard to get on and have it really work out. So make sure you've got a majority of your money in the overall broad indexes, especially in this market, and then wait for the run. It'll come. Something will pop up and really take off. And right now the money's just trying to figure out where it should go. And there's new things like, hey, they just cut rates 0.5% instead of 0.25%, right? And that's what's kind of fascinating here. Now, this is the CME Fed Watch, Market Watch tool, and this is the futures market. And again, this is hard to see, but I'll just give you the overall concept here. Right now, for the next meeting, which is November 7th, okay, so right after the election, so they don't have to worry about politics, and they didn't worry about it anyway. They did a 0.5-point rate cut right before the election. So, and right now, it's a 50-50 bet between a 1/4-point cut, additional quarter, or an additional 0.5 point.
Yeah.
There is 0% that we're going to stay the same. That's
Yeah,
the
because the
current bet.
Fed even announced that they expect that by the end of the year they'd cut 1%.
Yeah, exactly. And that's what the market had said before, the meeting too. So market and the Fed are starting to line up a little bit better. They've been kind of disconnected for most of this year.
Yeah.
That's for sure. So I think that'll be kind of interesting. Another 0.5 point. I'd be surprised, but I was surprised by this one. So who knows? And there's a lot of commentary about, well, is this, an issue where the Fed sees something that we don't? Is the economy actually weaker? The Fed has 400 economists on staff. I think they all have to have a PhD, the whole thing. And they still, unfortunately, get this wrong almost every time, which is kind of incredible. They over-raise rates or they don't raise them fast enough because it just shows you how difficult it is to do what they're doing. But it is fascinating to see because the market itself is a very fine-tuned, gauge. This is where people are putting their money, right? Matter of fact, I just saw a thing the other day where there's a data scientist that works on who's going to win the presidency based on the betting pools and not based on polls. And his thought process is probably pretty sound, and he was right in 2020. And it's just that the money, you're having to put your money up. You're not just answering a question, who you're going to vote for. You can say whatever you want. People are putting up their money and making bets. And so that's what we look at here. Is the people are putting up their money, making bets, and and once you get into that level, you end up with this machine that gathers information known as the market. Basically.
Yeah, it's kind of like you're crowdsourcing everybody together.
Yeah, and it's amazing. It's why the S&P 500 is a machine, right? The whole thing, the whole mechanism that goes around that, and it's one of the main predictors of future economic performance is the S&P 500. And again, we just set an all-time high yesterday. I'm telling you, the market is saying the economy is still going to be okay for the next 3 to 6 months, right? And you'll start to see true, breaking of the, primary trend and get into a primary trend down. That's a sign that we might be seeing problems in the next 3 to 6 months. Again, the market leads. It's not. It reacts. I'd say it's like 75% leads and 25% reacts to what's happened today, right? I mean, that's kind of so. Mainly, it's leading. And so what you're trying to do if you're trying to get ahead of the market is you're trying to guess where things are going to go. I tend to just look at the market and say, okay, where are things going to go? And then just kind of get in there. And you're later, but you're often more accurate than trying to guess. If you guess right where things are going to be, you make more money.
Yeah, it's like you take a single versus a home run, right?
Yes, right.
You're going to strike out a lot more when you're going for home runs than when you go for a single.
Yeah, and it's something we talk about all the time, the concept of predictive investing versus reactive investing, right? So predictive, saying, I'm predicting that this is going to happen, and I'm going to buy these stocks or this portion of the market because if that prediction is correct, that's going to be the recipient and it's going to win, whether it's anything, right?
Yeah.
Versus, hey, the market is moving over here. that's telling me something. I mean, cloud computing's just taking off, focused value is taking off, real estate's still hanging in there, and so let's ride those things and let's keep going with those until that, peters out, and then what else is coming? And so that's reactive. It's two different things. It's most of what you read about is predictive because it's cool. It sounds interesting. It gets a lot of clicks. Somebody's going to tell you. I mean, Jim Cramer, he just predicts stuff constantly on his show, right? Now, I just read an article where he said, just touted, I think 24 hours ago or something, FedEx dropped like 10%. Long term, it's probably a great company. Lots of things going through the mail now, but not today. Or not yesterday. So anyway, that's our summary for the week. Really, the market's doing quite well. I'm very excited that it broke out. Don't be surprised if it doesn't stay up. This is a weird time of the year. But you got to get past today. Just ignore today. Let's see what happens next week and see if we can.
Yeah, it'll be interesting with rebalancing too. At the end of the quarter.
Yes. Yeah, that's right. So that's a big one actually, because we've often seen a drop right at the end of the quarter because of the rebalancing. So that'll be interesting though, because bonds have done pretty well here in the third quarter on a relative basis. So maybe we're selling some bonds and buying some stocks this time. It's been a while since that's happened. So we'll see. But it is something to know about and be aware of. If you start to see really weird activity, the last few days of a quarter, it's sort of like today. You can kind of ignore it and wait and see what happens once the quarter's over. So, all right, good. Thank you for joining us for this portion. Again, I always like to do a summary here at the beginning, and we'll do another one next week. But we're going to jump into the questions now.
So this question came in during the summary. What was going to happen to bonds? What's the effect of the rate cut on bonds that you're invested in?
Yeah. What we've seen is that the bond market has done really well here. If we look at the last 8 weeks, the market's basically made zero, right? I mean, we just barely broke above where we were back in the middle of July.
Yeah.
The bond market had a nice run, and then it had a phenomenal run in 2020 when they lowered rates. So when they lower rates, especially like they did in 2020, the bond market goes up in value. That's a very straight relationship for the most part. And then it became a big bubble, right? And so in 2022, when they started raising rates, the bond market came all the way back down. In 2022, like the 10-year Treasury had its worst year in terms of price movement since 1783, right? So that is that's a problem. So what we're seeing right now, though, is that we've had, since that downturn in 2022, we kind of have a sideways motion that happened. And we've broken out of that. And the bond market's actually been doing quite well. Still, on a relative basis, if you look year to date, and the stock market's up over 20%, the bond market's nowhere close to that. But it is doing well for the bond market. And so the lowering of rates, just lowered 0.5%, that's good for the bond market. Again, the bond market's already anticipating some of that. So we had the run up before that. And then now the next bets will be on, okay, are they going to continue to lower rates? How much are they going to lower rates? And so the bond market, actually, this is a great environment for the bond market. You still might make more money in the stock market because this is also a great environment for the stock market. So the stock market averaged 14% on, 9 of those 11 last, rate cuts after 12 months. The bond market's probably not going to average 14% over the next 12 months. It's just not that kind of vehicle.
It just doesn't move that fast.
No, but it could be positive. It could be, you could get double digits, 10% or something along those lines. Usually when you see the bond market really, really going, there's something happening. And people are running to the bond market for safety and like the pandemic, right? But right now, yes, that's a good question. The bond market is doing very well right now, should continue to do well as they lower rates. I think the overall expectation by the market's about a 1.75% drop in Fed funds rates in total. And we just had a 0.5%. So in that case, there's a 1.25% to go. Bond market does quite well. Unfortunately, what happens is new bonds coming out are going to pay less, but you're getting compensated by price appreciation in the bond market right now. Because that's what happens when they lower interest rates.
Yeah, and you'll see more volatility for longer duration bonds than short duration bonds because they're they're more sensitive to any kind of rate change.
Yeah, exactly. It's like the end of a whip, you know. I mean, the handle doesn't move nearly as much as the end,
Yeah.
right? So that's how you kind of would look at the duration and length of term of a bond. Treasury bills don't move hardly at all versus 30 years, and or some of these zero coupons or whatever can really move a lot.
So should I be worried about the economy after a half point cut? Just what is the Fed seeing that made them do such a big cut?
Yeah, so this has come up several times, and it's been in the news and what have you too. And was before the cut happened, that was one of the things they kept talking about. Well, if they do a half a point, maybe they're doing that because they see something we don't see, right? And again, you know, they have 400 economists on staff. And however, I will caution you. Number one is the Fed's predictive capability has not been good historically, right? So whether they see something or not, I'm not sure it matters to a certain degree. It's kind of a weird thing, right? I mean, so if you've got an organization that has historically overraised rates and then caused these big recessions and then not raised rates like they did in this last inflationary run for like a year, everybody was saying raise rates, and then, you know, so their mechanism for seeing things is definitely questionable altogether. Now, so far, this particular rate increase has worked out in a soft landing scenario. It's been actually really good, and they're getting some credit for that. I'm not positive they should get all the credit. I think the pandemic offset of pent-up demand and government money that came out offsets the 5% increase in interest rates that normally would have caused a recession. Those two things have come out. And so that'd be my first word of caution, whether they see something or not. Now, very specifically, Chairman Powell does a question and answer session on Wednesday after they announce, you know, what they did during the meeting. And he said they don't see any specific area of the economy doing poorly. And so I do have a graphic here. And so it wasn't, the rate cut wasn't based on something that they're afraid of.
Yeah.
So you take that with a grain of salt. You know, sometimes they have to tell you what you want to hear, you know, those type of things that can happen. So this chart is just the last 3 rate cuts.
Or half point rate cuts.
Oh, half point rate cuts. Yeah. And so if it's green, that meant they needed to do it, right? Those particular categories were the ones where, so if you look at the 2001, there's what, 1, 2, 3, 6 green boxes out of all of them, right? So, you know, and then and if you look back at 2001, we were in a recession at that time, and market was falling quite heavily. Matter of fact, 2001, I think the market dropped 22% in total for the year, give or take, something in that neighborhood. If you look at 2007, again, 1, 2, 3, 4, 5 green boxes out of all of those different, you know, categories. CPI, we've got real GDP. And again, that was the beginning and the end of a big downturn in the 2008, you know, the Great Recession, they're calling that. If you look at where we are now, we have 2 green boxes, right?
Yeah, a lot more red.
A lot more red, which is just the opposite. The red, I know it seems kind of strange, kind of backwards, but the red means that you don't need the half point rate cut because these things are already doing well. Year to date, S&P 500, 26.5%, right? Those kind of things. So that's the I guess that's the answer. Is if you look at kind of the core pieces, CPI, core CPI, payrolls, the one thing, the real Fed funds rate. So this is the Fed funds rate minus the inflation rate. And those are green in every single time. And what's happening is that just shows how much money is, how much restrictive policy the money is currently in and how much out of neutral you are. So we're at, what, 2.88%? Lower end of all 3 of those, but that's why they did the 0.5%, in my opinion. They're just trying to get money back to a more neutral category. Unemployment is, went from 3.4 all the way up to 4.3%. So that is one of their mandates. So they're looking at that.
Yeah, but if you compare like previous times, those claims are much higher. There were a lot more jobs lost.
Yeah, exactly right. And so that's the issue as far as that goes. So that, you know, we've got a scenario where the Federal Reserve, I don't think, is really worried about what's going on in terms of the We got a beeping sound going on. I don't know.
Yeah, we got an alarm going off. Give us a second. Do you want?
Oh, it's a battery backup for our server. So. All right, we're back. Is that we have a UPS battery backup on our server that's going out on us. We're supposed to have it replaced next week, so we just turned it off. So basically, to answer the question is no. At this point in time, if you look at the data and you look at the gross domestic product is growing at 3%, all these things that are happening, they're not making this half a point cut because of economic, this is what they say, it's what I'm saying also, it's what I'm seeing, because of economic softness. They're doing this because inflation is down to 2.6%, and they don't want to wait until it gets back to the target of 2 because it might slide down into even a deflationary category of 1.5 or what have you. So this is just the first salvo that they're going after. And really, I said this before in my daily videos, if you look at the minutes that came out from the July meeting, there was an awful lot of talk and a lot of the governors who wanted to do a quarter point cut in July. And I think what happened here is that they ended up just doing July's quarter cut and September's quarter cut and made it a half. And then they did say in the interview, the question and answer of Chairman Powell, that don't expect more of these big cuts. Now the market, we just showed in the summary, is looking at half and half chance of another half point cut. But what Powell was saying was, at least the way I read it, was we're going to continue to do these quarter point cuts. And they could get to 1% that way quite easily, just 2 more quarter points, and they're at 1%, which is their target, right? So anyway, it's a good question, but I don't think it's a big issue, and it's why the market, finally digested everything and then jumped yesterday 1.7% to a new all-time high. Because I think you can see that you lower rates in a good environment, and hopefully inflation doesn't kick back up or those type of things that can happen. But yeah, I think they're doing it just because they've going to do a quarter point, a consistent motion all the way across. All right.
So, what are your thoughts on battery ETFs like LIT and BAT? I think LIT is Global X's lithium and battery technology ETF, and BAT is Amplify's battery technology or lithium and battery technology kind of ETFs.
Yeah, so this came in as a question during the week, and just a couple of narrowish ETFs. Focusing on battery technology and lithium and those types of things. And is this a good area to be buying in? The world seems to be slowly but surely shifting over towards battery type scenarios. You can get the battery backup systems for your home. They've got these huge installations with monstrous batteries. I remember reading about one in Australia that was pretty incredible. Cars, of course, all of these things that are happening. And so is there an investment opportunity there? And yeah, I'll share a chart again, since we got this last week. So the green one here is the Global X, the ticker symbol's LIT. It's a lithium battery technology ETF. And then the red one is Amplify. These are the only 2 real battery ETFs out there as far as that goes. Now, the green one, and this is, looking back to the, 2018 timeframe, middle of 2018, and that's up 25%.
Yeah, you can see that that right after the pandemic, they really ran.
It was up almost 300%.
Yeah,
it was at that point in time, and it's been unwinding since then. And what's interesting is that Amplify didn't get that big run. I think it was up about 80%, which is still a good number. for any investment. But it's now down in the last 5 years here, almost 36% down. So, you compare this to the S&P 500, who's up more than this year to date
Yeah.
for what this thing has made in the last 5 years. And so, what you're doing here is you're saying to yourself, "Hey, I'm going to buy this low because things cycle." And we presented this chart some time ago, and we brought it back up again. What's called the market curve, and so there's kind of hype cycle.
Mm-hmm.
So 2020 would have been a hype cycle for batteries and
Yeah.
all green energy things and what have you. And then there's this kind of facing reality. That's where we are right now,
Yep.
right? And then eventually you get that kind of run up. So you would look at like the .com, it's the hype cycle, and then we had a 45% drop, kind of facing reality. But then eventually we got Amazon, companies that made that. And so that's this kind of upward ultimate, market opportunity. But you notice here it says failed technologies come out of there too, because I remember reading an article about e-toys, which nobody remembers anymore, but it was much more popular than Amazon during that hype cycle. And so sometimes it just doesn't work. And then eventually it becomes a more mature market at the top there. So when you go back to this chart, you'd be saying to yourself, well, is the facing reality portion of this done?
Mm-hmm.
And are we going to start up, the more, market opportunity? Excuse me.
Yeah, and that could take some time. You have to compare where the charts have been. Where has the stock been or the ETF been prior? Is it still falling? And then you may want to look for some kind of bounce up. Is this, and then try and find a sustainable bounce up and to get in.
Yeah, exactly. Looking at this from a pure technical standpoint, it actually has a long ways to go down still to really reach any point of pure resistance. And most of the resistance that's out there, consolidation points are pretty far back, so they're not as strong.
Yeah.
And so, yeah, I'd be a little nervous about it because it's right at the moment, it's just a falling knife. I mean, there's just continuing down, and there's nothing to say right here in this chart to me that this is going to be a bottom. I'd like to see some proof, but it's very difficult because you can see there were a lot of, like, and if you look at the green line there with the global lithium, global X, had a bunch of run-ups in there. It turned out to be false.
Yeah.
I would certainly want to see a primary direction change. Let's see if you can set a higher high. If I'm looking at that chart, every one of those highs is lower, right? Except maybe the second one, right?
Mm-hmm.
But since then, and so let's see a higher high. And that's probably where I'd be trying to come in if I was going to do this. We don't do this type of narrow piece. Standard deviation is quite high. And those type of things. We've done some of this in the past. We were involved with some of these types of things in 2020, but generally, and you kind of had to in 2020. There was the overall broad market wasn't doing as well as some of the narrow segments, and they were going nuts. And so it was a better move to be in there. But that's not true today. Today we got a lot more rotation. I guess there's a lot more sanity in the market to a certain degree than there was in 2020. So anyway, that would be my concern with this. I don't have any problem with it as an overall concept. I do like the story. I do think batteries are going to be more and more important, and you're not just buying one.
You're buying the ETF, which is multiple companies.
Yeah, you're buying multiple companies, and if there's new technology that comes out, they'll go buy it and put it in that ETF, so you don't have to worry about, I bought XYZ battery company because they have this great technology. And it turns out it's either not great or they can't sell it or somebody else comes out with something better, right? You're insulating yourself somewhat so by buying an ETF, which I really like, over an individual stock. You make more money if you get the individual stock right. If you bought Amazon instead of eToys way back when, you've made a lot of money.
Yeah, so it's kind of like stepping down from like a home run to like a double.
Yeah, exactly.
You're still going to hit more than like the market if you get it right, if you like the theme is good.
Yeah, I like the theme. I just don't like the fact that I'm not convinced that the facing reality portion of that cycle is over. Right? I think there's still some potential room to come down there. Maybe a dollar cost average in. Buy a little. If it drops some more, buy a little. Just keep small amounts, accumulate as it comes down. I would look at this much more as a long-term hold. Kind of what's it going to be in 5 years? It could definitely be higher.
Yeah.
Right.
So
all right.
What is triple witching day? And then also what is zero, um, zero or 0 days till expiration options.
Got it. So triple witching hour happens every month. It's the third Friday, I believe, of the month.
It's
And
every 3 months.
oh, every 3 months.
Yeah.
Sorry, every 3 months, third Friday of that month.
Yeah.
And it's when all the options expire. So there's what options,
You got
contracts.
You got stock index options, stock index futures, and stock options kind of expire all the same
Yeah.
date.
And so it creates all kinds of volatility in the market, but it's temporary. It generally goes away pretty quickly and things get back to normal. And the zero date options is just buying an option now that's going to expire today.
Yeah, basically you buy an option the day that it's going to expire at close.
Yeah, because there's two parts of an option. One is what they call a time decay, right?
Yeah.
So because they do expire. So if I buy a 30-day option, that time decay portion of that option is going to continue to decay down to zero. If I buy a zero date option, I don't have to worry about the time decay.
Yeah, there's a very small premium on that time value.
Yeah, and now I'm just, operating around whether or not that particular holding, NVIDIA or whoever it is going to do well today after I buy that option.
Yeah, you're basically trying to play the volatility of the stock. So if you're doing a call option like this.
Yeah, so this is from bank rate. And so let's say it's at $20.
And your premium for the option is 10 cents. So you're paying $100.
So you pay $100 for the option, and it gives you, basically access to 100 shares,
Yeah.
right? If it goes to $20.10, you make your money back and you get a zero gain, right?
Yeah.
If it stays at 20, you lose your $100 that you paid. If it goes anything below 20, before the end of today, you lose your $100. Fair enough, but it's very sensitive, right? It can really go. And so if it goes up to $20.50, which is a fairly big move, but maybe not for a volatile stock like an NVIDIA or something along those lines, but you make 400%. You make 500 for your investment of 100, right?
Yeah, and this strategy has become popular more in the past, since the pandemic, I would say. It's very popular on the subreddit Wall Street Bets. A lot of people play these 0 day options because you can hit some massive home runs. And you also have limited downside. You can only lose how much your contract value, how much contract you
that's
pay
right.
for.
Yeah, if you bought 100 shares at $20, you could lose a lot more money in that ways and cost more money. But it does expire. Whereas I buy at 20 and it goes down to 19, I've lost money, but I can hang on to it.
Yeah.
And hope it comes back around. And if it does, good, I make my money. When it's just investing with a deadline, that becomes much more difficult. And then the deadline in this case is hours, basically, which is. So this is not something we ever do, that's for sure. But it's an interesting question. It came, it's something worth looking at to kind of understand the market a little bit more.
It can add some volatility, especially
Right.
if there's enough volume. It can change.
Right.
Move the stock up or down.
This has some impact on the market overall. Again, temporary. If you wait it out, it'll disappear. Wait till Monday, things start over again.
Yep.
Right. So, yeah, good question. All right, what's our next question?
Can you pass along a beneficiary IRA? And if you do, pass away and pass along this IRA, what are the rules of distribution?
Okay, so let's say my father inherited from his mother an IRA. So he has what's called a beneficiary IRA. And now my father passes away and I get that. So I've inherited a beneficiary IRA. And so it depends on when my grandmother, in this case, passed away and passed the money to my father. So because there is the 2020 Secure 2.0 Act, I think it was, that changed the rules around distributions from our inherited IRAs.
Yeah, so essentially what happens is, yes, you can inherit an IRA. You basically become a second generation owner of this. And so the rules are, if the original person passed away pre-2020, the owner, primary, let's go with primary beneficiary, would have a stretch IRA essentially.
That would have been my father in the case that
Yeah.
I was talking about. So a father would have been able to take out a little bit at a time, what's called a stretch IRA, just based on his age and such. And
Yeah.
so it was a really nice program.
Yeah, and so that was kind of gotten rid of with the 2020 Secure Act. And so what happened is the successor beneficiary now gets basically a 10-year distribution window based on the death of the primary beneficiary.
So I inherit my father's beneficiary IRA that came from my grandmother.
Yeah.
He was already doing a stretch. And so that means that I have to take that out over a 10-year period.
Yeah, and with the new rules, you would have RMD on your age, but
Right.
likely you wouldn't exhaust it by then. So, but that's how it would be set up.
Right.
And so, what happens if the person, passed away post 2020, the original owner, and then the next owner passed, a couple years later, let's say. So essentially, the new owner, the successor beneficiary, would have to assume the current timeline. So let's say they had a 10-year distribution window and the primary successor or beneficiary has used up 2 years.
Right.
So now you have 8 years to distribute everything. And likely you'd have to take RMDs on those 8 years too.
Yeah, so using the analogy again, so my grandmother passes away after 2020, so my father inherits this. He has to start taking it out over 10 years. He can't stretch it out over his life like he used to be able to. He has taken it out for, it's 2 years later, he passes away.
Yeah.
Now I have 8 years left.
Yeah,
right?
you assume their
versus
timeline.
the other scenario, my grandmother passes away before 2020. I got a full 10-year window to take it out. If my grandmother, in this case, passed away after the Secure Act was passed, I have to look at my father's, how long he has been distributing or supposed to be distributing or whatever you want to look like. How much of the 10-year period has he already used, and I get to use the rest. So it's kind of interesting. Of course, this is welcome to the IRS tax code.
They never make it simple.
No, they didn't. It's not that easy to make it simple, unfortunately. I mean, maybe it is. You just, you have to start all over. But
you start from scratch,
which isn't easy either. So anyway, that's how it works. It's a good question. It's really an interesting area.
Yeah,
we're seeing more and more of these.
Especially a lot of people
things
take
come up.
on stretch IRAs because there's a lot of stretch IRAs out there.
Yes,
And so a lot of people are now inheriting these stretch IRAs.
that's right.
Because usually a lot of times people don't deplete their stretch IRAs.
Yeah, that's right. Exactly, because if you follow the requirement of distribution table, which is what we used to do with these stretch IRAs, you'll have money until you're 115 to 120. I've forgotten where that is.
You can have money for a long time.
Yeah, if you just take out the minimum amount, it'll go for the rest of your life. But those are gone now. For all intents and purposes, if you already have one, that continues to go. That's fine. But if you inherit IRA money now, you're going to have some type of a shorter distribution window.
Yeah, unless you're an eligible designation, but unfortunately those don't apply for second generation.
Yeah, that's right.
Successors.
Okay, well, that's our show for today. We're ran a little bit over, but we used up some time with the beeping, so we'll call it even. And so again, if you'd like to ask some questions, send them in during the week, and we can, maybe find some charts or some other information. Send it to asktom@talkmoneywithtom.com. Be happy to answer those. And then of course you can go visit our channel and subscribe to the channel, hit the bell button, get notified, and if you like to, you can set up an appointment with Ethan and I. You just go to our website. There's a link here. There's a button looks just like that up in the corner, and you can find a 30-minute time to meet with Ethan and I, and we'll talk to you about your specific questions. All right. Thank you very much. Thank you for joining us today. Look forward to seeing you again next week.